Hey, what's going on YouTube? In this video, we're going to go over Celsius Holdings, ticker symbol CELH. Company reported their Q3 earnings November 7th and beat on top and bottom lines, and analysts are a mixed bag, half up, half down for EPS revisions for next quarter. Year to date, Celsius is up 49%, and on the course of 1 year is up also 50%. They do have a pretty high short interest against the company, sitting just shy of 18%, so something to keep a little bit of an eye on. That might tell you the company could be overvalued, and analysts are expecting lower price action in the future. And on to the earnings call. Overall, looked pretty generic. Just talked about how the growth was and all these other things. The key points that I found within this earnings call was that North American revenue increased 107% year over year from 180 million to $371 million. So very good growth there. Also, they were able to increase their market share from 4.4% up to 10.5%. Also, very solid. They are now the best-selling energy drink on Amazon with approximately 21.4% share in the energy category, ahead of Monster, which is at 18%. Red Bull at 13%. International sales grew approximately 56% in the third quarter, totaling 13.6 million compared to $8.7 million last year. So international sales are also growing very well. Prior year losses that they had, which we'll see on the financials here shortly, was primarily driven by their termination of their contract, their distribution contract, and they switched their distribution network over to PepsiCo distribution system. So I think personally, that sounds very bullish to me because PepsiCo seems to be stepping in and taking this company under its wing and helping it out dramatically by once they were able to sign a contract with PepsiCo for distribution, they are also helping them get into more of their networking and distribution locations. So that way they can expand their overall business, Celsius, in a lot of other stores as well. So I think this is a very, very bullish thing for Celsius in the near future because PepsiCo can help them expand dramatically. Also, one thing worth noting, they did do a 3-to-1 stock split. All that really does is just makes shares a little cheaper and a little more attractive and increases liquidity. Onto the 10Q on the balance sheet. Company's got $760 million in cash. Inventories did tick up a little bit year over year, but as the company grows, we would likely expect inventories to grow as well a little bit. Down to the liabilities. Company in total, if you strip out nothing, it has $508 million in total debt, and we've got $760 million in total cash. So you subtract out debt from cash, you are still left with a net positive balance sheet. That's very solid. Whenever I see that on a company, it always makes me feel very comfortable to invest into. Onto the income statement. Revenue year over year, we can see this dramatic growth year over year. We've already gone through that, how much growth they are seeing currently. SG&A expenses, see where we went from. This year, we're at $96 million in SG&A, and prior year, $226 million go. So they had to pay a penalty for canceling their contract, and obviously that gets put into SG&A expenses. That's why last year they saw a negative in income from operations, and we come down here, we can see a net income loss because of that particular business decision, which I think will benefit a loss that year, but I think that's going to pay off big time in the future. And now over to our cash flows. Net income carries over to top line in the cash flows. We got $177 million roughly in net income. This is over the last 9 months. We scroll down here, we got stock-based compensation added in of $16 million. We do lose about $44 million from deferred income taxes as well. Altogether, we're left with $136 million cash from operations. We strip out about $13 million of CapEx, which is leaving us with about $123 million in free cash flow in the last 9 months. So they've got a positive cash balance sheet. Very good. They got good future growth forecast. Obviously, we can see that the growth in the last year was phenomenal for them. Positive cash flows. These are all very good things, obviously, to see for a company worth investing into. Now over to the valuation spreadsheet. We're going to take a look at our charts on the right-hand side, and we've got our revenue, gross profit, net income. We can see this big drop in net income was from their distribution agreement and cancellation and switching over to PepsiCo. But overall, we can see our revenue is just on exponential growth with gross profit and net income. So we're seeing some very strong growth. Gross margins, last quarter was the best gross margins company has ever seen. So I think this move into PepsiCo is going to be a pretty big game changer for this company. Net margins, we're sitting at 21.8%. Again, best net margins they have had, and this was just in the last quarter. Trailing 12 months are sitting at 13.5. So they're heading in the right direction quickly. So this is very good. Revenue, gross profit, year-over-year change. I mean, we can just see the growth on the company right now is just exploding. Return on invested capital, obviously a relatively fresh company. We're not going to see great return on invested capital just yet. Same thing with earnings yield. PE right now sitting at 104. Obviously, that could tell you right there that this company could be very overvalued. Cash to debt, we already went over that. We can see cash. There's plenty of cash to cover all of our liabilities. Net income to free cash flow, we are producing more net income than free cash flow, which is always, in my opinion, a good thing to see. Free cash flow, we are sitting at about $100 million in free cash flow in the trailing 12 months. Capital expenditures only sitting at $13 million, are starting to grow quite a bit, but obviously still a pretty nominal number. Share count dilution, looks like they have stopped diluting shareholders overall. We can come up here and see how they are handing out shares. We can see stock-based compensation. They were issuing more common stock, but it looks like they are pretty much done doing that, at least for the time being. And then common stock repurchase, they are not in the position yet to be doing that. Obviously, they're a relatively fresh company and working on growth. They don't need to be worrying about buying back shares at the current moment. Over to the comps, we got 3 other companies to compare to. I believe Monster is really the only direct competitor. We do have Coca-Cola and Fizz on here as well for other comparables, just to kind of take a peek at margins to, just kind of see where margins could end up. So let's come down here over to our margins. In my opinion, this is the more important part, is to see and understand where margins could end up on this company. So we can see CELCIUS sitting at 47.5 and Coca-Cola 59. So we know, and we have already seen some growth coming from this company in their margins. So we can somewhat expect in this mid to low 50 range on potential margins, on gross margins. Operating margins, same thing. We can see that there's room to grow. If the other companies can do it, CELCIUS can do the same thing. They just got to figure out how to do it. They've still got some room to grow their overall margins across the board, which, as we can see last quarter, they are on track of doing so based on gross margins and net margins. As we come down here to PE, we can see where the competitors are sitting. PE, we can tell, obviously 104 PE on CELCIUS would really tell us almost immediately that this thing is probably very overvalued, but we'll take a look at that once we get over to the calculator. So over here, we have peer lunch valuation, getting us a fair value of $20.98 per share. Multiples comparison, $14.22 based on the 3 competitors we just compared to. And if we strip out Coca-Cola and Fizz because they could be less competitive, that gives us $17.79 per share. So that didn't change the overall multiple comparison all that much. Manual PE, another thing that could tell us we're a little overvalued, is we take our market cap minus cash, add in debt, divide by cash from operations. It'll take this company about 32 years to earn its market cap, which tells us we are overvalued right now. Price to book, though, 5-year average 56. Obviously, that's a high price to book. Currently sitting at 33.7. PEG ratio today telling us we are fairly valued, but forward-looking undervalued. Grams valuation telling us we are worth $19.66. Onto the discounted cash flow valuation. Average growth rate is negative 618%. Analysts did not have a growth rate expectation, and I plugged in 20% for an expected growth rate in the company for free cash flow. Gives them a DCF of $34.03. Down here on Rule 72 for an average EPS growth rate of 24.5%. Goes in 72 3 times. That goes in 10 years 3.4 times. So we double our EPS about 3.4 times to about 4.25, which gives us a fair value of $52.21. So on to the summary. So currently CELCIUS is trading just shy of $50 per share. We got a fair market value of $28.22, 30% margin safety, $19.75. Analysts have a price target of $68.12. So we have a lot of specific calculators here that are kind of telling us that right off the bat. We've got a PE of 104. We've got manual PE telling us we're overvalued there. Comparing to our multiples, it's telling us we're incredibly overvalued also right there, disregarding all the other calculators that we have. Almost every single one of them is telling us that we are very overvalued right now. So we're going to plug in the future EPS of this company, which we can come over here to Seeking Alpha. We can see our EPS forward is 76 and our forward-looking PE is 66. So let's plug in those 2 numbers and see what that does to our calculator and see what that gives us. So forward-looking, 12 months forward-looking, we're looking at $33 per share, $22 per share on our multiples. Grams valuation, 31. Our discounted cash flow will not change. Our rule of 72 could change ever so slightly here. Let's see. Yeah, it'll change from 6 to maybe call it 650. We don't go too high on this one because this is going to really affect it. So a fair market value on rule 72 is about $80 per share. So we come over to final valuation, even plugging in forward-looking numbers, we're not even coming anywhere close to where analysts are on this company. Obviously, there's a lot of growth, and obviously in our calculator spreadsheet here, we're forecasting 43% growth on our EPS and 56% growth on revenue. So even with forward-looking numbers, we're still falling very short from where analysts are at a $40.15 per share with a 30% margin of safety of $28.10. Over to the stock chart, we've got a long-term channel drawn in here. If we go back to the weekly chart, we can see this is incorporating price action going all the way back to basically the beginning of 2021. Several higher highs and higher lows. So we drill down to the daily chart. We can see we hit the top of the channel and have since been rejected off the top of that channel, are pulling back. To me, it looks like we're pulling back to the bottom of this green channel where support could be right around $40 per share, which would then be our forward-looking fair market value on this company. Obviously, there must be a lot of growth priced into this company. There does seem to be a significant amount of growth behind the company, but that is something that you obviously will have to pay a pretty penny for since we're trading at 104 multiple right now. And every single calculator that we have ran this company through, even with forward-looking numbers, is telling us this company right now is you're paying a very, very pretty penny for this company right now. I think this is one that you, unless you really believe in the story and are willing to overpay for a company probably by several years ahead of time, then otherwise I would probably just stay away and wait for this thing. Maybe you'll get a special little pullback on this company. Maybe it peak and boost through this green channel, comes back down to $34 a share. Maybe that might be your best buying opportunity unless things start really heading south on the company. But overall, I don't think that's going to happen. It's got PepsiCo behind it now. You know, it seems to be taking it under its wing. You know, there is a lot of positive things behind this company right now that you will you'll have to pay for. But that is it for Celsius. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.